every 100 days, the US debt goes up $1 trillion. So that was 30 days ago. Now it's every 99 or 98 days. It is unbelievably, almost to my opinion, my small mind, unsustainable. What is going to happen here? Based on what I know and what I've heard, there's three world reserve currencies. One is the US dollar, one is the euro, and one is gold. And gold is the only currency, reserve currency, that governments cannot replicate, i.e. print more of to devalue it.
We're speaking now with Ryan King. He is a Senior VP of Corporate Development and Investor Relations at Calibre Mining Corp, CXB on the exchange. We'll be talking about not just the company, but also Ryan's outlook on the mining sector and the gold space. Welcome to the show, Ryan.
Thanks very much, David. Appreciate the opportunity to be here and talk about gold and gold equities.
Calibre has a number of gold projects. So let's talk about gold first before we talk about those projects themselves. First question everyone wants to know: how sustainable is this rally? What are your thoughts?
Yeah, so it's a great question because it's the one everyone wishes they knew and nobody really knows. Everyone has theories for where gold is and why it's going up or down. But honestly, it just seems so unique every time. Okay, own gold in inflationary periods, own gold in deflationary periods, own gold when geopolitical strife is happening around the world. It just seems to be one of those things. But honestly, I guess if you take a step back and you look at gold as an asset class, as we print more money and as we have quantitative easing, and as we, as a Western nation, Canada or the United States continues to take on significant debt loads that almost are unachievable to pay back, it would seem that folks, or the price of gold, I should say, continues to have, at some point in time, there's no rhyme or reason as to when, but it seems as though it will continue to go up in value because our fiat currencies are going down in value over time. On a day-to-day basis, month-to-month, or year-to-year, we don't know. Now, we've seen almost a 20% increase in the price of gold since the beginning of the year. You have pundits out there that are very well followed, like Pierre Lassonde, that just recently came out and said, based on an S&P 500 ratio, gold could easily be at $19,000 per ounce US. You have gold in every fiat currency on the planet hitting record highs. You have Citibank that has just recently come out and said, they anticipate gold to be close to $3,000 an ounce by the end of this year. Or Goldman Sachs that has recently said $2,700 US per ounce this year. You have central banks that are buying on record demand, quarter over quarter over quarter for the last several quarters. It's a unique environment because investment funds or ETFs are seeing outflows of gold equities, right? But sticking with the gold price for the moment, it would seem like we're in such a unique time, i.e. extreme amounts of debt, where maybe there's a situation where the US or large nations like that have to reduce rates because they can't afford paying their debts, because they can't afford interest rates. I just heard a stat, you've probably heard the same. Every 100 days, the US debt goes up $1 trillion. So that was 30 days ago. Now it's every 99 or 98 days. It is unbelievably, almost to my opinion, my small mind, unsustainable. What is going to happen here? Based on what I know and what I've heard, there's three world reserve currencies. One is the US dollar, one is the euro, and one is gold. And gold is the only currency, reserve currency, that governments cannot replicate, i.e. print more of to devalue it. It's the only currency that doesn't have government intervention into that reserve currency. So I do believe that we were talking a little bit offline prior to the interview. I do believe we've probably seen a hot gold run here, which maybe is too much too fast. But maybe that was also a catch-up trade to look at how long gold had sat there at 1900 or 2000 and is finally starting to break out of that because of the demand by central banks. Particularly China, that I believe is selling US treasuries now and buying physical assets of gold. So where is it going? I can only think that based on what I read, what I see, what I hear, it is very likely that it's probably in the environment or the price it should be. And given that you've got Goldman Sachs and other, very smart analysts looking at, supply and demand and the global macroeconomic environment saying that it's going to be higher, I can only believe that's, who to trust.
One can only speculate, but do you have any idea as to why central banks have been stockpiling gold last year and into this year?
I think there's a lot of countries out there that realize that we're probably heading into a very tumultuous economic environment, i.e. debt levels too high, maybe some type of a reset, debasement of currencies. As I said, for example, the Chinese continue to sell US treasuries, from what I understand, and buy physical assets like gold because those physical assets are not being debased, right? So I don't know, but it would appear to me that maybe we don't have all the information yet, but in times like this, we've definitely seen gold go higher on the back of significant central bank buying if history is to repeat itself.
Here's a chart. Okay, Junior Gold Miners Index, the GDXJ, is the bar line, and the orange line is gold price. You can see that they've correlated perfectly throughout the year until recently. Divergence. It seems to me that traders are taking profits at a top a couple weeks ago, while gold's continuing to hold steady. Right? Why the divergence in sentiment, you think, between equities and the underlying metal?
Well, I think that right now there's various indicators that are saying risk off. Like, so maybe, equities, even though it is backed by gold that has been going up. But I think, I believe that we're so short-term minded now. There's so many people with online trading accounts, and masses that are, wanting to capture a little bit of alpha in a short period of time, right? So, we're seeing a gold price go up 20% and maybe equities going up 20 to 30% in 6 weeks' time. If you bought at the right time, people are going to take profits quickly. That's just the psychological nature of humans, right?
Let me just ask you a somewhat personal question. You are the VP or senior VP of corporate dev of your company. How are you feeling right now? Are you feeling good? Are you buying into this euphoria? Are you nervous about this ending soon? About not being able to be sustained? Are you feeling neutral because you've seen this before 2 years ago?
Yeah, I'm always a little bit more cautious in my approach. However, when I want exposure to gold, it's through an entrepreneurial effort with the group of guys that put together Calibre Mining. So I take a very long-term view here for putting businesses together. And really, when we take a look at Calibre, we restructured the company to become a gold producer in 2019. And that's when I first started really buying a position into Calibre. And every year over year, I've continued to add to my position because the business is delivering on what we said we would do. We're meeting and beating expectations of our investors. Gold is going to go up and down and up and down. But over time, it would appear to me that largely, again, because of the debasements of currencies around the debasements of fiat currencies, particularly the US, we're seeing these hard assets go up in value, and it's not going to happen overnight, but it is over time. And we're building a business that will increase our gold resources, or increase our gold reserves, and increase our cash flow per share as we develop our business and execute and deliver on our business. So I take a long-term view, and honestly, I know it's going to be up and down like a roller coaster over time, especially in terms of turmoil and volatility and change. But I try to take a longer-term view.
Have you seen more investor interest in the last 2 months with gold price going up to $2,300?
Yes.
Has it been significantly more than, let's say, in January when it was only at 2,000?
Yes.
Okay.
I very seldomly get incoming calls from larger institutional investors. And I've seen an influx in that over the last
That is
30,
interesting.
60 days.
Would you say, generally speaking, not just for your company, we will talk about your company plans, and I want to get to know what you want
Mhm.
to do with your assets, but generally speaking, do you think higher gold prices are actually, I would say, negative for M&A prospects for juniors? In other words, why would a senior overpay, right, for a junior company when gold is on an all-time high? We're breaching new all-time highs is probably the rationale. And so investors might be like, you know what, stay away from the sector when gold's really, really high because buyout prospects are low. Is that the correct approach to think about it?
Well, I think gold equities are trading at mass discounts, even to the price of gold at
Okay.
$2,000 an ounce, right?
Okay.
So if we take a case study, that would be Gold Corp in early 2000s, right? And you look at what Gold Corp did year over year, adding new assets as the price of gold through 2002 to 2011 went from about $250 an ounce to $1,900 an ounce in 2011, right? So if we look at that example, I would say that I think that there's a huge influx of M&A that is about to happen. Yes, there's cautious optimism about the gold price staying here, but companies that are producing gold, if you're not finding it through your exploration efforts, guess what? You've got to go and acquire it. You've got to issue shares and acquire advanced stage exploration or ready assets to go into production.
I remember talking to some seniors a few years ago when gold was at its previous all-time high post-pandemic. And they said that one of the mistakes that the industry has made was overpaying and going on what they described was irresponsible shopping sprees back in 2011 when gold was
Yeah.
at its then all-time highs.
Yeah.
What do you think they're going to do differently if, let's say, these memories are still fresh on people's minds? They don't want to repeat the same mistakes.
Probably spend a heck of a lot more time doing due diligence.
Okay.
Honestly, I mean, mistakes were made because assets weren't great. I think that was a big part of it. Mistakes were made because people were being rewarded for pipelines instead of cash flow per share delivery. So it wasn't necessarily about free cash flow margin. It was about what's your production pipeline look like over the next 6, 12, 18, and 24 months. That's how people were getting companies were getting rewarded from a share price performance perspective. But then you look at that and you look at what was required to deliver that in terms of capital intensity, time, and projects actually delivering upon expectations based on engineering reports. It didn't deliver. So it was destructive period of time where now I think companies have learned from that. They've cleaned up balance sheets. They've spent more time doing investigative work and due diligence, as well as investing in their own assets to organically grow and to make sure that there's good free cash flow margins. That's one of the critical elements right now is all investors are looking for free cash flow, particularly large institutional investors is looking for new areas where there are companies generating actual strong price to earnings or free cash flow margins versus, in some cases, tech companies that, have great innovation and inventions, however, are not generating reasonable cash flow per share or earnings.
I want to get your thoughts on this. I've heard the argument that gold ETFs have been not great for the mining sector. In other words, is capital flowing into an ETF that could have gone directly to the companies. And so, from the company's perspective, how do you feel about these products?
Well, this is part of the reason why I think that passive investments like this, indexes and ETFs, part of the reason why we may not see as much capital flowing into individual stocks. For sure. I would agree with that. I mean, I don't know what the numbers are, but if you look over the years, ETFs, yes, they'll look at buying, in the case of a GDX or a GDXJ, they'll actually buy a very large position depending on your market cap and trading liquidity, and will sit on that position for a period of time until you don't meet the metrics they require to stay in the ETF. So there's large events that happen to get included and then get excluded out of that ETF. And investors, whether it be retail or investment advisors or other funds, they trade around these events that get telegraphed out to the market. based on individual companies in the portfolio, and that's all disclosed by the VanEck group of companies, right? So it has taken capital away. However, if you meet the metrics, you get included. For example, Calibre was just included into the VanEck GDX ETF, so the larger of the two. And on one day, at the end of the day, which was already well known based on analysis, we traded 54 million shares, and that was where, you know, a number of funds will buy the stock and then sell it to the ETF for one big printed trade. So, you know, we would lose out on that capital that would go directly to, you know, potentially Calibre or other gold stocks. So capital goes to that product.
So you're a Canadian listed, America's focused gold producer. Tell us about the results from your last quarter. So significant increase in revenues from the previous year. Congratulations. Was that a result of just the gold price, or have you upped production volume?
Yeah, thanks. So we're in Central America and Nicaragua. We acquired assets there in Q4 of 2019. And originally, the anticipated result there was 50 to 70,000 ounces a year.
This was a new acquisition you made last year?
This was in 2019.
Okay.
Right. So that's how we became a gold producer to start with. Calibre was an explorer in Nicaragua. We then transitioned to become a gold producer because we acquired these assets in a very collaborative win-win deal with B2 Gold. So B2 had begun their company in Nicaragua by building the Libertad facility or mill and operating the Limon mine and mill. So they were producing 125 to 175,000 ounces a year from those assets for 10 years prior to Calibre being there. We were able to strike a deal where they became a significant shareholder of Calibre, and we paid some in cash. So it was a $100 million deal we did back in 2019 when gold was $1,200 an ounce. It's not that we had foresight knowing that the gold price was going higher, although I'd maybe like to claim that, but but nonetheless, no, it was, you know, a deal where B2 Gold had become focused on their very large assets around the world. We became almost a subsidiary of B2 Gold because they reported some of our production, because at the time, I think they owned almost 30% equity in Calibre. But the big transition here was when our CEO, Darren Hall, who's been an operator for 30 years, and what he did was he worked for Newmont and optimized assets in their portfolio, lowered costs, utilization of infrastructure, et cetera. And I could tell many stories about his career and what he's done. But what he did here with these assets was unlocked a significant amount of value via a change of operating strategy, right? We went from two separate mills and assets to really consolidating them together and operating what we call a hub and spoke approach. So that first year, we produced 136,000 ounces of gold in the full year of 2020. In the following year, we produced 180,000 ounces of gold by bringing on new satellite deposits and feeding them into our existing infrastructure. So the return on invested capital is very high. And we were able to do that by using operating cash flow and reinvest back into the business and the drilling and the development of new satellites to feed into our infrastructure. And that gave us a platform from which we could grow. And that's where we went in 2021, acquired a cash flowing exploration company called Fiore Gold in Nevada, which is a 40 to 45,000 ounce a year producer on a heap leach operation, a 220 square kilometer land package. So incredible exploration opportunity there, which gave us a diversification, a first step in diversification of the company. And so, you know, that was a long-winded answer to say that last year we did 283,000 ounces of gold. And Q4 of 2023 was a record quarter for us, 75,000 ounces of gold production. So we had seen organic growth. We'd seen some inorganic growth in Nevada, but we continued to deliver. I think it's been 17 quarters now where we've delivered. We've met or beat expectations from the 11 analysts that cover the company.
Also, slight improvement in your gross margins. I'm just noticing just a quick back of the envelope calculation. 2023, 30% gross margin income from mine operations over revenue and 25% in 2022. So can you explain the 5% increase? What happened there?
Year over year, we've seen an increase in average grade mined. So we've discovered new areas. And fortunately, those new areas have been higher grade than previous ones mined. And I'll give you an example. At our Limon operation, we currently mine open pit about 3.5 to 4 gram material and 5 to 6 gram material underground. Well, through the investment we did in exploration, we discovered what we call the Pantheon North Zone, which is it's not huge at this point in time. It's about 300,000 ounces at roughly 9 grams per ton gold. So, the margin is being offset by some inflationary impacts, but because the grade is offsetting some of the inflationary impacts, but we're also seeing the benefits of increased margins.
So year to date, I think I'm looking at the share price, Calibre Mining, 38%. It's outperforming a lot of your peers. How are you going to continue to add shareholder value, I think is the question investors have on their minds.
Yeah, no, that's obviously a question as to where we're going, and I think it's very exciting times for Calibre. Over the next year, we're developing a new property in Canada. So we just recently closed a deal with Marathon Gold where we acquired the Valentine Gold Mine, which is a 5 million ounce open pit resource deposit in the central region of Newfoundland. What's exciting about this is that the project is already 62% through construction. And we would anticipate by H1 of next year to be adding that new asset to our production portfolio. And so based on a 2022 feasibility study, it is anticipated that on average for the first 12 years of a 14-year reserve life, the asset will produce 195,000 ounces of gold a year. So upon delivery of this asset, and I'm very confident we're fully financed to be able to deliver this project, that Calibre will see a 60% production growth by delivering this asset. It'll also help lower our all-in sustaining costs across the consolidated asset base. And of course, this is 5 million ounces in Canada in a jurisdiction that has a lot of exploration potential. So it's continued drilling, continued delivery, continued execution on the construction of the project to be able to be in production by the first half of 2025.
And you recently closed $115 million of financing. Tell us about that.
Yeah, so look, anytime a company of our size, yes, we're producing 275 to 300,000 ounces of gold this year, and we have a solid balance sheet. But a company that's in a position of strength, you always want to think ahead and be proactive. We're building Atlantic Canada's largest open pit gold mine. We've seen companies that have run into funding issues. We have seen companies that have had significant CapEx increases, and we're planning ahead. We have a very high level of comfort and confidence in what it's going to take to complete this asset. We want to ensure that we have a good buffer there. So when we got approached, an unsolicited approach for a bought deal financing by the Bank of Montreal, the company thought very closely about it. The board decided to go ahead and proceed with the equity financing, which is about, at the time, a little less than 10% dilution for the company, but puts us in a very strong financial position to cover any sort of increases in capital and deliver the Valentine Gold asset by H1 of next year.
If your investors are saying to you, Ryan, well, look, you've already got significant improvements in margins over the last year. You've got $86 million of cash as of December 31st, 2023. You're generating great EBITDA. Why don't you just not raise shares, dilute equity, and just grow organically? Could you do that? How would you respond to that?
Look, that's an option always, right? But when you're investing anywhere from $20 to $25 million a month on construction of a new asset in Canada, yes, you're in a position where you're generating some good operating cash flow, and the price of gold has gone up, so that's even benefiting you further. But you never know when something's going to go bump in the night. And so you want to be prepared for that, planning ahead, being proactive about anything that could come out of left field. So Yes, absolutely. We were in a better position than most in these circumstances. But when somebody approaches you to do a bought deal financing during a time of a large construction investment to be able to increase production 60% and then transition from a junior to a mid-tier gold producer that has higher multiples, I think that's a very smart and prudent approach rather than being in a position where you come out with some news and say, oh no, capital cost has increased, cash flow has reduced. Oh my goodness, we're in a tough position. Well, I think the share price would probably be a lot lower if we were in a position of weakness to help us finish financing and completion of the build than in a position of strength.
And I notice you currently don't have a dividend policy, or at least you're not paying dividends. Is that correct? Are you planning to change that anytime soon?
Well, the biggest thing we have on our plate at the moment is delivery of this asset, this
Okay.
new asset in tier one jurisdiction. So that's our focus right now. With the transaction, we did take on $225 million of Sprott Resource Lending, a facility there with Sprott. So as we advance the project, we anticipate drawing that capital. So 50 million of that capital has been drawn. There's 175 remaining. So, when it's all said and done, we'll have over $200 million US of debt on the balance sheet. And the company would like to really focus on paying that back as quickly as possible. So that will be a focus for us, as well as investing back into particularly Valentine here, given the exploration upside. In my view, in our view, is that discovery of ounces, economic ounces, can be quite valuable for share price performance. Dividends, 100% would be something that we would be reviewing in the future. Absolutely. Once we get to a 400,000 to 500,000 ounce a year production profile. We also do have in place potential for share buybacks. So we got approval for that last year. But again, our focus is delivering Valentine, getting that up and running, and then paying down debt as quickly as possible.
I want to end on gold one more time. We've come full circle. So we've talked about how you think gold could go higher for the number of reasons you've listed. What could ultimately be the catalyst for, let's say, I'm not going to go as aggressive as Peerless on its $19,000 gold, but if we were to move towards $3,000 an ounce, which some people have told me it's possible now, given where gold's already been running up, what would that catalyst be, Ryan?
Well, I think that as the Fed continues to talk about rate reductions, if we saw rate reductions, I think we're going to see an explosive move to the upside on gold. Probably various investment instruments as well. But I think that will be one. If we were to see some type of quantitative easing, in addition to that, I think that would be massive for gold. Again, that to me is significant because of the debasement of the currency, right? And very likely the supply and demand is starting to get interesting, given the amount of central bank buying continues to buy, and it is price agnostic, it would seem, at this point in time.
Nobody has a crystal ball, but what is the high end that would not surprise you by the end of the year?
$2,500.
Okay. Makes sense. Thank you very much. Where can we learn more about Calibre Mining and keep up to date with the developments there?
Yeah, obviously the best communication tool at the time is, and the easiest is calibremining.com, our website. And you'll find information where you can call me directly there on the website or email me directly. We do put out a lot of news, and there's information in our news releases as well as to ways to get in touch with the company. But yeah, best communication tool is our website.
Perfect. Thanks very much, Ryan. I look forward to speaking with you again soon. Best of luck with your current developments.
Thank you, David. I look forward to it.
Thank you for watching. Don't forget to follow Calibre Mining in the links down below, and don't forget to subscribe and like this video.